So you have the opportunity to move from Hong Kong to the UK. But do you know all of the tax matters that you need to consider? No? Well, go check out this video as I go through one by one. Hi there, my name is Simon Misiewicz from Optimise Accountants. I'm here to help you grow your wealth whilst reducing your tax liability whilst you're moving from Hong Kong over to the UK. We're going to help you understand all the tax considerations that you need to take into account. Now, when you come over to the UK, you may or may not need to register for Selfassessment's tax return with HMRC. And it's largely going to be for those people that are self-employed. Now, if you're coming over to Hong Kong, from Hong Kong to the UK and going to be self-employed, earning above £1,000 worth of profits, which for most people you would, then you would need to register for self-assessment tax returns. You may be coming and to invest in buy-to-let property. And again, if you've got any income over £10,000 as rental income, you will need to register for self-assessment tax returns. Indeed, if you have more than £1,000 worth of profits, then I would suggest you need to register for self-assessment as well. Now, you could be coming from Hong Kong to the UK to be an employee. You might work in a business. Now, you don't have to submit a tax return online unless you are earning above £100,000. Once you do that, then you are going to have to register for self-assessment tax returns. You may also make some investments, whether that's into shares or other kind of stocks that you buy and sell, some other business assets that you receive an income on. Well, again, you will have to submit a tax return for that. Now, I have gone into a bit more detail about this subject of should you register for self-assessment tax return. There's a video that I've done for you on that. The link will be appearing above my head and below this video as well. So do check out that video. In essence, though, you will need, if you are going to register for self-assessment tax returns, you will need something called a UTR. You will need, a UTR, by the way, is a 10-digit number, and it basically stands for Unique Tax Reference Code. That is unique to you as an individual. You will need to request that UTR from HMRC. Indeed, you will have to call a different number if you want to obtain a national insurance number, which is slightly different from a UTR. So everyone really has two codes to their name. Now, you only need a UTR if you're submitting tax returns to HMRC. A national insurance number is something that everyone will have, and it enables you to make national insurance contributions for your private healthcare and for your state pension as well. Now, if you're coming over from Hong Kong to UK and you go to register for self-assessment, you will need some other details like your personal details, so date of birth, address, etc. And that will help HMRC identify who you are so that they can appropriately give you the UTR and national insurance numbers. Now, the interesting thing about this is the tax year for the UK is very similar, not very similar, is the same basically. So the tax year runs from the 6th of April to the following 5th of April. So you pretty much should be familiar in terms of those tax years. Now, if you are doing paper filing, you will need to do that via this paper form to HMRC by the end of October. But most people, I have to be honest with you, will leave that tax return until the 31st of January. Now, if you are going to submit your tax return by the 31st of January, you do need to be aware that you need to also make the payment of tax to HMRC, which doesn't really give you much of opportunity to save if you're calculating and paying that tax liability all on the same day. So in all honesty, try and do your tax return nice and early after April so you can work out exactly how much tax you got to pay on the 31st of January. You don't need to pay it, but it does help you to make those plans. Now, what I want to do is make a direct comparison now of the tax rates between the UK and Hong Kong. And if we look at an income tax top rate, now both the UK and Hong Kong have got tiered tax rates. So Hong Kong starts from 2%, the UK goes from 0% to 20% basically. And I have to be honest, personal allowance as well, you do get a personal allowance in Hong Kong, so you got a 0% as well there. And now the top tax rate, as you can see, the UK is heavily taxed at 45%. In Hong Kong, you're only going to be charged at 17%. So if you're thinking of earning the same amount of money in Hong Kong in the UK, then you need to work out the fact that you are going to be paying this heavier tax. That means you'll have less net pay. In the UK, we have also two other taxes that you may not be aware of. And the first one is CGT. If you dispose of a property, you will have to make a capital gains tax payment for the gain you make on that asset. And we'll talk more about that later on. We've also got IHT, which stands for inheritance tax, which is a death tax, which again is subject to the assets that you have in your name. And once you pass on, you get this tax-free allowance, and then any excess will be subject to 40%. You don't have that in Hong Kong. So you do, again, need to really work out, should you be moving to Hong Kong? And we've got some brilliant examples to help you with that decision. Now, if you're a non-resident, as in you don't live in the UK, but you have income from there, then you will be subject to income tax in the UK based on the income generated in the UK. As an example, if you have real estate property invested in the UK, you will pay income tax based on the income tax rates just for that property. You won't have to pay UK tax on any form of Hong Kong assets that you have, nor will you have to pay Hong Kong tax on that foreign earned income either. So that's a good thing. CGT, capital gains tax, again, if you're a non-resident, as in you don't live in the UK, you're not a resident in the UK, and you've got capital gains tax, as in disposing of assets, again, it will be just for UK assets. And equally, if you invest in the UK, that grows in value, and you will have this tax to pay called inheritance tax. That too will only be based on UK assets. Now, the problem becomes if you become UK resident, and I'm going to go through a little detail in terms of what makes you a resident person in the UK for tax purposes. So stay tuned for that in just a little while. But what we need to take into account is that potentially, if you're a resident in the UK, your worldwide income could be subject to UK tax. And we've just already highlighted the fact that the UK tax rates are fundamentally more than the tax rates that you pay in Hong Kong. So you could have this double taxation going on. CGT, again, if you become resident in the UK, you would be subject to CGT on your worldwide assets. So unfortunately, if you've got property left in Hong Kong and you are resident in the UK and then later on sell that asset, you could be subject to CGT. So why not dispose of those assets before you become tax resident in the UK? Something for you to consider. Equally, if you become UK resident, and I'll give you a different terminology for IHT purposes, but if you become UK resident, then IHT could be subject to worldwide assets, not just those based in the UK. And I've got an example where it might frighten you, so much so that you choose not to live in the UK. I'm not trying to scare you off, but I think you need to be aware of all of these tax matters that you need to take into account. Now, if you've got income tax, how does that affect you from Hong Kong? Well, if you've got income tax if you've got income generated in the UK, you may or may not have to pay tax in Hong Kong up to that 17% tax band. Now, if you've got foreign earned income, you don't have to pay tax. But if you've got employment income and you're shipping it over to Hong Kong, then you may have to pay this 17% top rate tier for tax in Hong Kong. Of course, we mentioned already that you don't have to pay capital gains tax nor inheritance tax on UK or Hong Kong assets. So that is a relief. You will only have to really consider the UK tax affairs. Now, you might be looking at this information and thinking, crikey, there's a lot of information to take on board. You might be right. So that's why we've built an online community for you to watch a bunch of videos where I've described this in a lot more detail. And I provided you with tax calculators as well. Those tax calculators will help you build your wealth whilst reducing your tax liability. And I'm live as well every Wednesday to take your tax questions. So start your 7-day free trial now and start saving tax tomorrow. Moving on to residency status. What makes you UK resident? Well, as soon as you stay in the UK for more than 183 days, you're automatically going to be UK resident. So more than 183 days, you are likely to have two impacts here. The first one is that you might decide, well, do you know what? I only want to be taxed on my UK income, and I will be happy to pay the remittance charge. The second section is where you're a resident in the UK because you stayed here more than 183 days, and you decide to be taxed on your worldwide income. That is a choice you need to make for yourself. I'm going to give you a comparison now to help you understand, should you be taxed on worldwide income, or should you use this thing called the remittance basis charge. Let's go through some examples in a little while. And then finally, you have inheritance tax. So this death tax that you'll have to pay. If you stayed in the UK for 15 out of the 20 years, you will be subject to inheritance tax, not just in the UK, but worldwide assets as well. We have a number of clients that stay in the UK all the way to the 14th year and then disappear before the 15th year to avoid this terrible tax that you will be subject to upon your death, which at 40% is a lot of tax. Now, I did talk about the remittance basis. Now, this is quite complex, and this is where I would say that a tax consultation really would be beneficial for you. Now, if you're in the, if you decide to say to HMRC, look, I only want you to tax me on my UK income, not my worldwide income, and this regard Hong Kong, then you will have to pay this remittance basis charge. And if you're in the UK for 7 out of 9 tax years, you will have this extra £30,000 income tax charge to pay. Now you might think, well, that's really high, and who would ever want to do that and maybe be taxed on my worldwide income? Well, I'll give you an example of where that plays out and where it doesn't. That tax charge, by the way, of £30,000 does increase to £60,000 when you spent 12 years out of the 14 in the UK. And finally, if you stayed in the UK for 17 out of 20 years, then that goes up to £90,000. That's a horrible amount of money that you would have to pay in addition to the tax you paid on your UK income. So really high numbers that we're talking about. So it's really important for you to understand which method you are going to use. And what I want to do here is give you an example. Now, if you're earning £80,000 in the UK, you'll be subject to 40% tax. So that's the high rate tax band. So 40% tax. Now, if you've got £50,000 extra income from Hong Kong, converted into sterling here, then it's likely that you may have paid 17% tax in Hong Kong. You will get a tax credit of the difference between 40%, but you're still going to be subject to 23% income tax, which based on the 50,000 income, you are going to pay 11,500, so 11,500 in UK tax based on the £50,000 money generated from Hong Kong. Now, if that's 11,500 a tax you're going to pay, are you better to use the remittance basis? Now, again, if we go from the middle example here, you've been in the country for 12 out of the 14 years, you've got an income tax charge of £60,000 if you are only going to be deemed to be taxed on your UK income. Well, if you're only going to be taxed at 11,500 based on the £50,000 earnings from Hong Kong, you may be taxed on your worldwide income, not the remittance basis charge. Again, can you see how complex this is? A tax consultation would be worth it. Now, what I'm going to do for you here is if you've got £150,000 worth of income, you are likely to pay 45% income tax, which is the additional rate tax charge. In Hong Kong, you might be earning over £1 million. Now, if that's the case, your tax rate will be 45% less the 17% tax rate in Hong Kong, which gives you a 28% UK tax rate, which is £280,000 worth of tax you have to pay to HMRC. Now, if again, you're in this country for 12 out of the 14 years, you've got an income tax charge based on the remittance basis of £60,000. Well, by golly, that is much cheaper than paying £280,000 on the £1 million worth of income generated from Hong Kong. So that is where using the remittance basis charge would be very much beneficial for you than being taxed on your worldwide income. Again, these are talk about big numbers, and it's really important for you to understand which strategy is going to work out for you. Now, there is a video I've created. The link will be appearing above my head and below this video, talking about inheritance tax. Now, the reason I've created that video is because you, based in Hong Kong, will have no concept of inheritance tax. So it will be brand new for you. So I wanted to create a video for you so you can have a look at that. Please check that video out because that is really important for you to understand that. What I want to do though for you is to help you understand if you're non-resident versus UK resident. And don't forget, we talked about if you're in the country for 15 out of the 20 years. Now, if you are less than 15 years, then you are only going to be subject to inheritance tax based in the world on your UK income. Now, let's imagine you've got net assets. So net assets is the gross value of your assets in the UK, less the liabilities, loans, mortgages, etc. So if you've got £300,000 worth of net assets in the UK, you do have an IHT allowance of £325,000. There is no IHT liability. So that's nice, plain and simple. But let's imagine now that you go over that 15 years by staying in the UK. Well, golly, there is a lot more tax to pay. So it's similar. We've got £300,000 worth of UK assets, which you will get a £300,000 tax relief. But now we've got £2 million worth of assets in Hong Kong. Okay, you've only got a £25,000 IHT threshold to offset that £2 million. Which means that you've got now £1,975,000 worth of assets that's going to be subject to IHT upon your death, as in death taxes. And you're going to be paying 40% on it, which is an incredible £790,000 of inheritance tax to be paid to UK HMRC based on those assets in Hong Kong. Does it make sense for you to be resident in the UK for 15 years? Or should you be thinking, well, let me get my calendar out and on the 14th year, let's plan on moving to a different country because I don't want to be here and pay that excessive amount of inheritance tax. This has been a brief video, but I hope it's given you some insights. And if it has done so, give me a thumbs up if you've enjoyed it, or indeed if it's frightened you, but made you more informed. If you've got any questions, then make sure you drop me a line. And of course, don't forget to subscribe to this channel. If you want to talk to us about our accountancy services, there will be a URL below this video. And indeed, if you want a tax strategy consultation with me, Simon Misiewicz, then there'll be a link as well there. Don't forget to use the code YouTube25 to get your 25% discount as well.